I want to bring in Tasha Keeney joining us from ARK Invest. She's an analyst. Tasha, great to have you back on the program.
Good to see you.
Thank you. So firstly, I want to just point out your recent tweet about Tesla and the ride hailing. We're going to hit some different companies today, but walk me through this case because I think it's pretty interesting. Is this a real possibility for them?
Yeah, I'm very excited about this. So this is my latest research. So basically in the past, Tesla said that they could launch a ride-hailing network ahead of reaching full autonomy. So this would have human drivers, and basically they learn the ins and outs of ride-hailing. What's so interesting about that is that we actually think that a ride-hailing network with human drivers could be a very profitable business for Tesla, basically because they have a lower cost structure than Uber and Lyft, thanks to their vertical integration. And it's actually just cheaper to drive a Tesla on an operating cost basis because it's a performance electric vehicle. So we think this could be a massive opportunity for Tesla, and it's really being overlooked. If you think about, we have our bull and our bear thesis for Tesla. Our bear thesis assumes that they don't reach full autonomy because it's still sort of an unproven area. But this ride-hailing network basically provides sort of, a downside protection risk on that case. So they still transform their business into a software as a service-like model. And we think it could be a great opportunity. And Tesla should actually launch now. Because the gig economy, people are wanting to get back to work, and consumers are avoiding public transportation. I think it could be a great opportunity.
It almost sounds like there's like a pseudo kind of philanthropic element to this in a way. Not really the precise word, but given the circumstances of what's happening right now, would it be profitable to Tesla, or is this going to be a distraction from their core message, which is still trying to stay profitable and get the business going?
Oh, we think it could be very profitable for Tesla. I mean, if you look at Uber's market in core cities, they're getting a 45% EBITDA margin. We think Tesla could actually get higher because, again, they have a better cost structure than Uber and Lyft. They're vertically integrated on the finance and insurance side. And on top of that, it's a better equation for the drivers if this car is actually cheaper to drive per mile, because then you can imagine the drivers get more take-home pay, or Tesla could take a higher take rate off of those gross revenues. So, Tesla could, and they'd also get more miles for autonomy if they do successfully launch a ride-hailing network. So it actually furthers that goal as well. So I think, there's a clear business case for this.
And it doesn't have to be fully autonomous, even though Elon's been talking about that again lately.
Exactly. Yes. So today, Elon said that he's very confident that they will get the basic functionality of level 5 autonomy this year. And, Tesla is really ahead of the pack on this front because they have this massive data advantage. They're taking data from customer cars. So again, this would actually further that goal, because then these cars would be very highly utilized vehicles compared to personal cars. They're used less than 5% of the time. A taxi gets over a 30% utilization rate on average. So this could just get them more miles, basically more data to feed that engine and to prove to regulators, hey, this is safe.
Yeah, all right, very cool. Let's talk about a few companies here, because in the list of companies behind your guys' funds, most of them are either at or near highs. ARK-Q for the year is up 32%. ARK-K, two of your ETFs, that one's up 61%. So today I want to go into some of the ones that are lagging here. And the really interesting companies, Tasha, I want to start with Stratasys, which is basically part of the 3D printing story. What's going on here? I would think that this would be in a lot of demand right now if there's supply chain problems and hang-ups for getting parts.
Yes. So Stratasys is certainly one of the most undervalued 3D printing companies. It's trading like a value stock. It has a price-to-book ratio below 1. And what we clearly think is a growth industry. We think 3D printing is around $10 to $15 billion today in its market, and it could go to roughly $90 billion in the next 5 years. So there's two sides to this story right now. So 3D printing, it comes in, it's very key in a time like, the current pandemic, because it basically allows you to, certainly in plastics, create parts cheaply and very quickly. So if you need a part fast and you don't want to wait for the injection molded tool to print it, you're going to look to something like 3D printing. So we've seen all those face shields that have been 3D printed. They're 3D printing nasal swabs. But they're also 3D printing pieces of actual medical equipment that's going into hospitals because they need those parts fast. The other side of this is, well, what's happening with the other traditional industries that are not the medical space that are using 3D printing? And, of course, this is to buy a 3D printer, that's a capital decision. So you would see sort of in the shorter term some delay in those capital purchases. But in the longer term, certainly coming out of this pandemic, we think companies, there'll be supply shortages. I mean, we've already sort of seen that as certainly sort of the auto industry and these more industrial industries have started to ramp back up after the shutdown period. There's going to be supply gaps. And again, if you need parts fast, you're going to look to something like 3D printing. In fact, Airbus, that's how they first got to using Stratasys technology for some of their parts. They were in a pinch and they needed the parts fast. They still use the technology today because it has so many advantages. It saves on cost, it saves on weight, and that can be huge for an aerospace player, especially on the margin side. So I think longer term, sort of that's the story with 3D printing, that it helps you bring manufacturing closer to home, and it helps you solve those supply gaps. So I think there'll be this other sort of burst that we'll see coming out of that industry.
So why is the company been so flat in its revenue for the last 5 to 6 years? I'm looking at the yearly revenue between 600 and 700 million. It's actually declined the last couple of years coming into this. Are they not getting big industrial customers to renew contracts? Are they not figuring out the perfect products to be printed on a regular basis? What's going on there?
Yeah, so to talk a little bit about the history with 3D printing. So, in the 2014-2015 period, there's this consumer hype phase, the idea that there'd be a printer in everyone's house. That never materialized, and we don't think it ever will. In fact, the best use cases for 3D printing are in industries like healthcare and aerospace. And those industries also happen to be highly regulated, and it takes time for these companies to work 3D printing into their specifications and to get those parts approved. So I think investors coming out of that consumer hype phase were sort of expecting a faster acceleration of those exciting end-use part applications, parts that go into the final product versus a prototype. But it takes time. So I think we are, in terms of that top line revenue growth, they've had this period now where they've been able to work with companies like Airbus, like Boeing, and work their way into those specification requirements and those approvals. And certainly, for in the medical space, we've had insurance codes for 3D printed parts are a new thing. You couldn't previously get coverage on some of these 3D printed implants. So we've really been laying those backbones over the past few years. So again, I think going forward, that's where you'll sort of see, that work pay off.
So is the printer a high margin investment eventually, or is it still expensive from a per unit basis?
Yeah, so for a per unit basis, well, I guess what 3D printing is really best at is parts that are low volume and very complex. So that's why it's great for aerospace. For instance, it's great for building rockets because there aren't that many pieces. You're not building, millions of rockets. You're only building a small set number. And 3D printing can get you these architectures that you couldn't get with traditional manufacturing. So you can combine parts, you can make the parts stronger, and you can often switch materials as well, which reduces weight. So you really, you have to look at it on this holistic view. I'm iterating faster in my design phase, so that saves me time. I'm able to quickly prototype and then change my design if I want to. And then on the other end of things, I'm able to save on the weight equation. So you really sort of have to look at that full picture view to see the benefit of 3D printing. But we're seeing great early signs of that. There are over 100,000 Stratasys parts flying right now on airplanes today. So we know that this is a proven technology, and it's in the market. It works.
All right, so it's not necessarily about churning out a bunch of stuff at a high rate and high margin. It almost sounds like there's still kind of almost an academic theme to it in a way where it allows people to experiment, try different things. What about Proto Labs, another stock in your guys' fund? This looks like it's connected, if not directly to 3D, but overall within parts making, and it's done fairly well this year, back to a 52-week high post-COVID. It's dropped off a little bit. What's going on here?
Yeah, so Proto Labs is a rapid part manufacturer. So they're really good at low volume part batch runs. And basically they have a highly automated process. It makes it really easy to get a quote on a part, and then you know when you're getting it, and you'll get it fast. So they use 3D printing, but they also use traditional technologies like injection molding. So actually, they've had a lot of orders come in during the pandemic. So they've had over 4 million parts produced or on order related to COVID-19. This is diagnostic equipment. These are medical supplies, and it's using some of their traditional manufacturing, like injection molding, to do that. But they're able to get those parts again because they're so highly automated, and they have this software, very turnkey approach to manufacturing. Again, that makes it perfect for a company that's sort of in a pinch and needs the parts fast.
Right now, this is a company that's making money on the bottom line. It generates earnings over the past year, about $2. So really interesting take here from the innovation side. And where do these fit in on the weighting? Just remind us here for the funds, how does this compare to the autonomous cars and the vehicle plays?
Yeah, so for our funds, all of that information is online. You can see, since we're ETFs, we actually we have emails that go out every day that show our trades. But Stratasys has always been a top position for us. Proto Labs is up there as well in the portfolio. But again, all that information is online. You can see for the fund. Tesla, our largest position, if you consider that an autonomous vehicle play. So we have very high confidence in both of these industries, and we think certainly during a time like now, companies are going to look to innovation in general, because that's how you get this better, faster, cheaper. And when you're forced to cut costs in your core business, and when the rest of industry is slowing down and you need to reconsider things, you're going to look to these new innovations, really sort of across all of the technologies that ARK looks at.
All right, judging from the price action this year, it seems to be the case. And we actually got it right there, about 29.7%, about 30 for the 3D printing composition in the fund. Appreciate you joining us, Tasha. Good stuff as always.
Thanks for having me.
Thanks a lot. Tasha Keeney is an analyst at ARK Invest.